Have you ever walked into your local coin shop when it's finally time to sell some of your silver? Then, when you ask what they're able to pay, the offer they give you is less than spot? Your immediate thought is usually, why would they pay less than what it's worth? But that question assumes something that actually isn't true. Because in the physical silver market, there isn't just one price. There are two connected systems running at the same time. And once you see how those systems interact, the whole picture starts to make sense. Good morning, it's today again. Welcome back to Joseph's Reserves. I'm Joseph, and I store 20% of my income in the form of rare coins and precious metals. Congratulations to John Modrzejewski for being the first to comment on yesterday's video. Thank you so much for your continual support. Today I want to break down something almost every stacker runs into. Why coin shops pay below spot for pure silver. But more importantly, why that isn't arbitrary. It's structural. Because once you understand how these coin shops rotate between two different markets, the pricing stops to look so confusing. When most people look up the price of silver, they usually end up on a site like Kitco.com. And for a lot of stackers, that number starts to represent the real price of silver. But something important to understand is that Kitco is not setting the price, and neither is any single person or company. They're actually looking at a composite price, a live reflection of activity happening across two major global systems. The first is the U.S. futures market. It's run through the COMEX, which is part of the CME group. This is where large institutions like banks and traders are buying and selling contracts for silver. Not necessarily the physical metal, but agreements based on future delivery. This market is extremely liquid, extremely fast, and heavily uses speculation and hedging. And because of that, it plays a huge role in what people call price discovery. The second system is the London bullion market, governed by the LBMA. This is more focused on wholesale physical trading between large institutions, banks, and bullion dealers. Instead of short-term contracts, this is a closer real-world bulk metal movement at the institutional level. So when you see a price on Kitco.com, you're really seeing a blend of those two worlds. The COMEX in New York driving fast-moving futures prices, and the LBMA in London reflecting wholesale physical trading. And aggregators like Kitco display the combined activity in real time. But even understanding all of that, here is the key point. None of those systems are the same as a coin shop. They represent large-scale institutional trading and wholesale benchmarks, not small physical transactions between dealers and the public. So the number you see online, it isn't wrong per se, it's just not the full picture of how physical silver actually changes hands in the real world. And that's where the confusion begins. Because once you step out of those institutional markets and into a coin shop, you're in a completely different layer of pricing. So now we understand where the spot price comes from. It's the COMEX and the LBMA, and Kitco is displaying these combined results. But that still doesn't explain why a coin shop offer feels lower than expected. And to understand that, we have to zoom out and look at how most businesses actually operate. In almost every normal retail business, the model is quite simple. A business buys from a wholesaler and sells to the public. And that's all the flow. They buy from wholesale and they sell it retail and they create the profit margin. And because of that system being so standardized, it's clean. The product is consistent, the pricing structure is predictable, and the margin is built from the start. And on the opposite side, there are also businesses that operate the other way. There are companies that buy from the public and sell to wholesales. Think like recyclers, scrap producers, or bulk aggregators. Their model is they go from the public, they sell it to the wholesaler, and in that bulk resale, they produce a profit margin as well. Again, that system works because it's still mostly dealing with a standard input. And now is where it gets complicated, because coin shops don't just operate on one of the system. They operate on both systems at the same time. A coin shop is essentially doing two businesses under one roof. On one side, they're a traditional retail business. They buy from wholesale suppliers like mints and distributors, and they sell to the public. So their stock is clean, standard products: silver eagles, maple leafs, gold bullion coins, the list can go on. This side behaves just like a normal retail store: wholesale in, retail out. But at the same time, they're also operating the opposite direction. They're buying from the public. And this is where the key difference appears, because what comes from the public is not usually the same product that comes from wholesalers. It might be junk silver, worn coins, random rounds from different mints, partial collections, or ungraded miscellaneous silver coins. Even if the metal content is identical, the product is not standardized anymore. Moreover, the customer decides when they are going to sell it to the coin shop rather than the coin shop buying when they need inventory. So to push this point further, let's say a coin shop just ordered American Silver Eagles from a wholesale, and then the next day someone comes in and sells 500 American Silver Eagles. Understanding this is very important because now the coin shop has extra inventory that they may not be able to sell fast enough for it to make sense to hold on to all of it. This is where selling to the wholesaler is actually a necessity so they can get that money back and be able to continue their business in normal operation. And since most of the time buyers will dollar cost average into silver while sellers will dump entire collections, it creates this bit of a mismatch between what is coming in and what is actually staying as inventory. So to stay balanced, the coin shop has to maintain a spread that accounts for both sides. They have to sell it at a high enough margin that if they were to order it from wholesale, they would still make a profit. But they also have to buy it at such a low rate that if they sell it to wholesale, they will still make a profit. So that is why a coin shop will offer below spot even though they're selling the coins above spot. Not because the spot price is wrong, but because the coin shop is constantly moving between two different roles: a retail seller on one side and a wholesale buyer on the other. Now, up to this point, it may sound like the coin shop is the main place where all the pricing adjustments happen, but that's actually not true either, because the wholesalers themselves are also constantly adjusting their prices. Now, that would be simple enough, but the reality is the wholesalers are changing their pricings throughout the day. Just like retail, they are reacting to supply and demand in real time. So the spot price you see online is really just the reference points, but the actual physical market is constantly shifting above and below that reference point depending on local demand. So let's walk through this. When a coin shop orders inventory from a wholesaler, that wholesaler is not just pulling coins aside from a static warehouse at some fixed price. They are managing the flow. They have to balance what's coming in and what's going out. And there's something that most people never see happen behind the scenes. The wholesalers also compete with each other. So if one wholesaler wants to move more of a certain product, they may temporarily offer better prices to buy from the coin shops or dealers who are willing to sell it back to them into the system. So instead of just saying, here's the price for Silver Eagles today, what's actually happening is closer to this: we need some more Silver Eagles in the system, so we are willing to pay slightly more to the dealers who bring them in. And that ripple effect moves through the entire chain of the market, because if a wholesaler is willing to pay more, coin shops suddenly have a better exit price for that product. And if they have a better exit price, they can sometimes offer slightly better deals to the public for that specific item. So this is where it gets interesting on a smaller local level. A coin shop isn't just reacting to national pricing, they're also reacting to what walks in through their door. If a shop suddenly has too many Silver Eagles, or strong demand for junk silver, or a shortage of generic silver, they adjust accordingly. In some cases, a coin shop may temporarily offer better prices on specific coins, not because the spot changed or massive demand changed, but because their local inventory position has changed, and they know that they can move that product quickly back into wholesale channels. So what looks like a simple spread, spot, the coin shop, and the customer, is actually a moving system influenced by wholesale demand, inventory shortages, local supply flow, and how quickly dealers can reposition the metal. So if I had to simplify all of this into one idea, it would be this. Even the wholesalers are adjusting prices based on supply and demand, and those changes ripple all the way down to the coin shop level, sometimes even within the same day. Once you see that, you realize something very important. The price of silver isn't just one number. It's constantly shifting around a network of buyers, sellers, wholesalers, and local demand, all reacting to each other in real time. And this is where it actually becomes practical for stackers. Because once you understand how fluid all of this pricing really is, you start to realize something very important. There's no single best silver product all of the time. For example, some days Silver Eagles might have a tighter spread when you go to sell them back. On other days, generic rounds might move more effectively. Junk silver might be in higher demand locally, or sometimes silver maple leafs or libertads might carry a stronger premium depending on the market cycle. And none of that is permanent either. It changes based on wholesale demand, local inventory, and how quickly a dealer can move a specific product. So this is why I personally always suggest a variety of products within a stack. Not because one is better than the other, but because it's impossible to know which form of silver will be the most liquid on the day that you need to sell. Because in reality, the best silver isn't just about the metal content, it's about market flexibility. When you diversify your silver, you're not just diversifying metal, you're diversifying liquidity. If you like today's video, make sure you go down and give it a thumbs up. Go into the comment section to start a conversation or continue one. Share this video with someone you think may like it, and subscribe if you haven't already. But most of all, thank you so much for watching. And just remember, every ounce adds up. So no matter how small, just keep stacking.